If Jerome Powell looks at the conditions on the ground, especially when you start to see inflation stay in the low twos and approach 2.0, the real thing that he's going to be under tremendous pressure to justify is, why are you not cutting? And just to give you a sense of how important that is, if we cut by 100 basis points, that's another $300 billion. Now, in that case, that's not money that we get in, but it's money we don't have to spend. So if you add these two things together, we are in the next 60 days going to have to reforecast the American balance sheet where this is, or we're actually going to be able to positively forecast an extra $600 billion, $300 billion of incremental revenue and $300 billion of savings. Jason, if that happens, watch out.
What if I told you the U.S. government is on the brink of uncovering a hidden $600 billion boost to its balance sheet without printing a single new dollar? That's exactly what billionaire venture capitalist Chamath Palihapitiya predicts on the latest All In podcast. He lays out a scenario that could transform everything: falling inflation, aggressive interest rate cuts, and a sudden surge in fiscal breathing room for the U.S. economy. If he's right, a major policy shift with huge market implications could be just weeks away. At the core of Chamath's prediction is a simple question: why hasn't Jerome Powell cut rates yet? With inflation nearing the Fed's 2% target, Powell faces growing pressure to act. Chamath argues that if the Fed cuts rates by 100 basis points, a move markets have been eagerly awaiting, it could immediately save the government $300 billion in interest payments on existing debt. This drastic reduction in expenses would have a swift and powerful effect on the federal budget. But that's only half the story. The other half comes from a surge in tax revenues, especially capital gains taxes, which Chamath estimates could add another $300 billion to government coffers. Together, this creates a potential $600 billion windfall, enough to force a complete reforecast of the U.S. balance sheet within the next 60 days. If this plays out, Chamath predicts a massive inflow of capital into the U.S., fueling a bullish run for asset prices. In this video, we'll unpack how rate cuts, inflation, and market forces are aligning into a perfect storm, what broader macro trends investors should watch, and why the Fed's next move could either ignite markets or throw them into chaos. This is how you buy and sell crypto the easy way, using eToro, one of the world's leading trading platforms. If you're new to crypto, eToro makes it super simple. Let me show you how I bought Solana in just a few taps. First, head to the search bar and type in Solana. Tap on it, then hit trade. I'm going to invest $10, that's the minimum. Now just hit buy and done. I now own Solana. Selling is just as easy. Go to portfolio, tap your Solana asset, then click close and confirm your sale. Super simple. That's how quick and beginner-friendly eToro is. But here's why I use eToro. Earn up to 4.3% interest on non-invested funds, 0% commission on stocks, and you can set up an account in just minutes if you want to start your crypto journey. Use my link in the description to sign up to eToro today and start trading.
In the early 2000s, I think that there was a war of ideas, and there was a group of people that advocated for this reckless form of free trade and this globalist view, like every country is going to meld into one mega monolith country organization that'll get governed out of New York by the United Nations and its sleeve organizations. And that worldview won. But it was the wrong worldview. And it didn't acknowledge that we have competing philosophies, competing priorities, competing ideals of what the future looks like. And I think that we need to go back and reset all of those things. If you just take where we are, if you can just put the Sankey diagram back up, there's a couple things that are really worth noting that people need to fundamentally understand. I said a couple of weeks ago that I thought the GDP print was going to come in hot. I think everybody now is sort of where I am.
Why is it hot? Do you have a thesis on why GDP spiked so much? Or potentially did? It's obviously a forecast.
I don't know the puts and takes yet. And I think when we see the print, I have a way of forecasting this stuff, which is a bunch of signals that my team and also many macro teams all around the world, the bond vigilantes to the hedge fund guys, they all feed it to me. And what I was noticing was that we were going to come in, I said in the low threes. And I think, if Atlanta Fed is right, I don't think they are, but I think it's going to be in the low to mid threes. It's going to be meaningfully greater than what people are expecting. So let me just give you my next prediction. My next prediction are two really important things. What this Sankey diagram looks at, which is a snapshot of the balance sheet and the health of the United States in May, misses, in my opinion, two very important things that have to change. The first, and this is a positive for the Trump administration and the United States economy, is we are run rating $300 to $400 billion above forecast in terms of our receipts, meaning the revenues that we will take in. And you get to that number by looking at the last 3 months of tariffs and forecasting forward, assuming a reasonable balance here. So back to Tucker's point, yeah, we all thought that this was like a boogeyman, that you weren't allowed to touch it, and that if you touched the stove, you were going to get burned. The mathematical reality is that this is actually going to work out much better for us than we anticipated, and it's going to be somewhere in the range of $300 to $400 billion of extra revenue per year. That's a huge win. So why is that important? That then sets up this next cataclysmic thing that we're going to see over the next 60 days, which is, what does Jerome Powell do? If Jerome Powell stays politicized, his incentive will be to keep interest rates where they are. If Jerome Powell looks at the conditions on the ground, especially when you start to see inflation stay in the low twos and approach 2.0, the real thing that he's going to be under tremendous pressure to justify is, why are you not cutting? And just to give you a sense of how important that is, if we cut by 100 basis points, that's another $300 billion. Now, in that case, that's not money that we get in, but it's money we don't have to spend. So if you add these two things together, we are in the next 60 days going to have to reforecast the American balance sheet where this is, or we're actually going to be able to positively forecast an extra $600 billion, $300 billion of incremental revenue, and $300 billion of savings. Jason, if that happens, watch out. What does that mean, watch out? It means that every single risk dollar is going to run to America. Every single one.
Yum, yum.
Forget Japan, forget Europe. There is no place to put your money except the United States. So I think that we have to figure out how to get Jerome Powell on the side of America versus on the side of what could happen politically. Because I think that there's probably a version in his head that says, my gosh, if I do this, it helps Trump. And if I don't do it, it hurts Trump. Practically, that is true. But the reality is the conditions on the ground justify cutting. I believe that these decisions are political. I think that the Federal Reserve has veered away from actually controlling the money supply in the best long-term interests of the United States and more towards what benefits the short term. And this ties back to how I started this.
What is Powell's motivation?
Somewhere in the 2000s, Jason, we transitioned away from having the strategic 20-year conversation about what's in the best interests of America. And instead, we started to have these unipolar globalist conversations. And the people that got into these centers of power, the IMF, the World Bank, the Federal Reserve, the central banks around the world, they all worked towards an agenda that is now being undone. I'll give you an example of where this is now being undone. Just today, the World Bank undid a rule around being able to fund nuclear energy. And you would have thought, well, hold on a second. The World Bank steps in to backstop all these developing countries when they're in the middle of all this nonsense, right? And if you think about a country that's developing, what is the single biggest input to that country? Energy. And you think for the last 40 years of multi-trillion-dollar bailouts, we never demanded abundant clean energy in the developing world? Of course not, because it was a political decision.
To understand why this potential $600 billion shift matters, we need to zoom out from the raw numbers and consider the broader macro landscape. The U.S. economy has been delicately balancing high interest payments on record national debt, slowing inflation, and uneven growth. What Chamath is pointing to is a rare and timely opportunity, where falling inflation gives the Federal Reserve political cover to cut rates, allowing both markets and federal revenues to respond in tandem. A rate cut wouldn't just be a monetary adjustment, it would be a powerful signal that the tightening cycle is over. If Jerome Powell initiates aggressive cuts, it could unleash a ripple effect across the economy. Asset prices would likely climb, borrowing costs for consumers and businesses would fall, and investor sentiment could turn sharply bullish. The impact wouldn't be limited to traditional markets, it could spark a renewed appetite for risk in equities, crypto, and venture capital. But Chamath's insight extends beyond monetary policy. He's highlighting a fiscal turning point. If the U.S. can save $300 billion on interest payments while pulling in another $300 billion from increased capital gains taxes, the federal balance sheet shifts dramatically, creating room for new stimulus, public investment, or even strategic debt reduction. However, this scenario hinges on several critical factors: continued disinflation, a Fed willing to act decisively, and markets that respond with optimism. None of these are guaranteed. But if those elements align as Chamath predicts, the second half of 2025 could mark the beginning of a new economic chapter, one of renewed momentum and opportunity. It's not just about rate cuts. It's about unlocking a fiscal and financial reset that could catch many investors by surprise.
Well, let me give you another data point.
Yeah.
Okay, now let's just scenario play. What happens if Powell rips in a 100 basis point cut right now? I'll tell you. So one part, which is mathematical, is the interest on the debt goes down. We save $300 billion. But there's something else that happens, which is the Fed does control the front end of the curve, meaning how do people borrow money for small amounts of time, from 1 day to about 2 years? If you make that cheaper, we know it's a test that's true as time. What happens is people borrow more money. That fuels more growth. That will end up in GDP. So what actually happens if you cut rates 100 basis points is not just the 300, but you can get this reflexive positivity in the economy. What that allows you to do is, even if that causes a little bit more inflation, you're actually growing yourself out of this whole thing. So then you ask yourself, well, hold on a second. If the numerical justification is there to lower rates, and it has all of these other positive externalities for the United States economy, why don't I do it? The only answer is political.
If you're Powell, it's better to take the risk of being Paul Volcker than Arthur Burns. I mean, that's basically what it comes down to.
Unpack that for people who aren't familiar.
Because what happened is Arthur Burns let inflation slip the leash in the 1970s, and he's remembered as a horrible Fed chair. And then Paul Volcker came in and jacked up rates to I think close to 20%, and caused a vicious recession in 1982. But by 1983, the economy had bounced back and inflation basically was under control. And then the rate cutting cycle started, and that rate cutting cycle went for 25 years. And then Reagan got reelected in 1984. So you'd rather be a Volcker than a Burns if you're a Fed chair. Now, you raised the question, is Powell political? Yeah, of course he is. If you go back to, was it 2021? So the first summer of Biden's presidency, we got that shock 5.1% inflation print in May of 2021, if my memory is correct. What did the Biden administration do? They sent Janet Yellen out to say it was transitory. And Powell got on board with the whole transitory narrative.
Exactly.
And as a result of that, he did not raise rates for 6 months. And worse than that, they continued QE. I think they bought $180 billion of bonds in that time period. And that's what allowed inflation to get so out of control. Now, why is it that Powell did that? Because he wanted to get reconfirmed. And yes, he was nominated by Trump originally, but Biden renominated him. And he basically wanted the reappointment by Biden. He wanted to get confirmed. And then the month after he got confirmed, all of a sudden he shifted gears and started raising rates again once he was safely ensconced in his office. So he did the right thing in terms of raising rates in the face of inflation once he was free from those political incentives. But for 6 months, he was intensely political, and that cost the United States dearly.
Dearly.
So now, if you're Powell, you've got PTSD from that whole experience, and you're going to err on the side of not letting inflation come back. I think with inflation down to 2.4%, I think it is time to cut rates, but he's fearful because, again, his incentives are to be a Volcker, not a Burns.
Yeah. And you want to read a good book, Paul Volcker's Keeping At It. Great book about has Reagan going to him and trying to get him to cut rates. So this is a reoccurring story. Just on. But
if he had done the right thing in the summer of 2021, we never would have had that bubble at the end of 2021.
Yeah,
that basically created a huge crash in 2022, and we could have avoided a good part of that if he had done the right thing. Like the Fed chair, it's not a hard job most of the time. I mean, these guys sit in their ivory tower, and then once a quarter they come out and do this, and basically testify and say a bunch of, things that no one can understand. But once in a while, you got to get the decision right. And he totally screwed it up in that one time where he had to get it right.
Yep.
And I would say this could be one of those moments too, where I think he's being a little bit fearful.
I think that there's a simpler explanation, quite honestly. If you look at Powell's history, he was nominated as a governor by Obama. Then Trump picked him out of the Fed to be chair, but then he was reappointed by Biden. If you look at the vice chair of the Fed, Phil Jefferson, he was appointed by Biden. If you look at Michelle Bowman, who's the vice chair for supervision, she was appointed by Trump. Michael Barr, appointed by Biden. Lisa Cook, appointed by Biden. Adriana Kluger, appointed by Biden. Chris Waller, appointed by Trump. So I think the point is that there is a balance of power here. If you look at political affiliations that tend to favor a democratic view of the political landscape. And let's be honest, what benefits the Democrats more? A thriving economy and a shrinking deficit going into the midterms, or the exact opposite?
Chamath Palihapitiya and David Sachs have outlined a high-stakes scenario with potentially massive consequences. The Federal Reserve stands at a critical juncture, possibly preparing for a major rate cut, while the U.S. government re-evaluates its balance sheet amid shifting political dynamic. Their argument isn't just theory, it's grounded in historical patterns, economic data, and a clear understanding of how monetary policy and political pressure often intersect. If they're correct, the Fed's next move could spark a regime shift, not just in traditional markets, but across the entire digital asset space. For crypto investors, this moment may carry more weight than most realize. Historically, Bitcoin and other risk-on assets have thrived during periods of loose monetary policy. In March 2020, the Fed slashed rates in response to the COVID crash, and Bitcoin surged from under $5,000 to nearly $65,000 in under a year. Even in milder cycles like 2019, Bitcoin doubled from its lows. A 100 basis point cut, as Chamath predicts, could reignite institutional appetite for crypto. With lower yields making traditional assets like treasuries less appealing, capital often flows toward high upside, high volatility sectors, crypto being the prime destination. But it's not just about liquidity. There's a deeper shift underway, one that ties together political momentum, innovation narratives, and growing institutional interest in crypto. If the economy starts to rebound, expect renewed excitement around stablecoins, tokenized assets, and decentralized finance. Looser monetary conditions combined with tech-forward optimism could usher in crypto's next major bull run. If Chamath's thesis holds true, we could be standing at the edge of a major macro pivot, one where digital assets are not just beneficiaries, but leaders. So the big question now, will Powell act, or will inflation fears keep the brakes on? Let us know what you think.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.